We actually were about $1 lower about a half hour ago before I started recording. This is all after the close of the U.S. stock market. So we've had some late day volatility in the oil price. But to me, as I mentioned on the last podcast, the chart looks incredibly strong for oil. I think we are about to break out and challenge the high that we spiked up to, which was around $130 a barrel. I think we can easily take that high out and power forward to $140, $150 a barrel before we have the next correction. But any correction that we have is likely going to be a correction in a bull market. But what I am looking for in these markets is any kind of indication that investors are starting to look beyond this inflation fight to the recession fight. In other words, look past the rate hikes that the market is currently pricing in to the rate cuts that are likely to follow, because what the Fed is doing is either going to push the economy into recession, or it already has succeeded in pushing the economy into recession. It's just that nobody has acknowledged this. And again, I pointed this out on a podcast before, but I've never seen an example of a recession that the Fed forecast in advance. In fact, even in the Great Recession of 2008, we were at least 6 months into that recession, and as far as the Federal Reserve was concerned, it was smooth sailing. There was no recession anywhere in sight, even though we were in the midst of the worst recession since the Great Depression. Now, this recession could easily be much worse than that one, but it doesn't surprise me that if we're already in it, the Fed still has no clue, because it's always looking in the rearview mirror for confirmation of a recession, and it has its own bias as to how strong it thinks the economy is. After all, Ben Bernanke felt the economy was really strong in 2007, 2008. That's one of the reasons that he thought it was impervious to the problems both in subprime and in the housing market. Janet Yellen, who was at the Fed at the time, made the same mistake. She was not worried about the housing market and said that even if she was wrong and housing prices went down, it wouldn't impact the economy because we had such a strong economy that it didn't matter what happened to housing prices. What Janet Yellen didn't understand was what she perceived as strength was in fact a bubble. The economy wasn't strong, it was actually weak. There was weakness that was masquerading as strength because the strength was a function of a housing bubble, and that housing bubble was unsustainable, and the spending that was powering the economy was associated with artificially low interest rates and home equity extractions and the wealth effect of rising home prices, and all of that went away very quickly. And so whatever strength the Fed believed existed in the market vanished very quickly, and what they were left with was a great recession. Well, Powell and everybody else are making similar mistakes now with respect to the perception of this super strong economy with this red hot labor market. All of that strength is a function of the inflation that they created. They acknowledge that there's inflation now, finally, and they want to fight it. But what they don't acknowledge is whatever growth they think the U.S. economy is experiencing is in fact inflation. So we don't have a strong economy, we have a weak economy. We just have an economy with high inflation, and what's driving that high inflation is the spending of printed money, of borrowed money. And when the Fed is looking at the economy and jumping to the conclusion that it's strong, all it's looking at is spending and confusing spending with economic strength without realizing that the spending is a function of inflation, and it is revealing the underlying weakness in the economy, especially if the Fed paid more attention to the trade deficits and the budget deficits and saw that the source of this phony strength lied in those huge deficits, and those deficits were also a function of the cheap money and artificially low interest rates that the Fed is now threatening to take away under the false assumption that the economy is so strong that it doesn't need that support, when in reality, the only thing keeping the economy propped up is the very support that the Fed is threatening to remove.